Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have Andrew Brewer. Andrew is a commercial operator, developer, and founder of IronGall Investments. Prior to starting IronGall, Andrew was a stationary engineer who oversaw operations at commercial facilities valued at over $200 million. He successfully completed full building turnarounds of underperforming commercial assets, leading to improved operations, lower maintenance costs, and improved resident experiences. In addition to his engineering work, Andrew has acted as a consultant in construction defect litigation lawsuits. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Thanks for joining us, Andrew. Can you start by telling the listeners a little bit more about yourself and what you do?
Yeah, for sure. So I'm based in Austin, Texas now. I am a real estate developer, and I also have a portfolio of buy and hold properties focusing primarily in the manufactured housing and RV space at this point. And then I develop properties, would develop single family home subdivisions, apartment communities, and townhome communities. Although now that we are buying manufactured home and RV parks, we are developing some properties there or expanding our current holdings there through, developing vacant land that we've purchased as well. So that's kind of what I'm doing now. I live in Austin and I work at this point exclusively in the Austin MSA and also in the San Antonio MSA. So here in Central Texas, I like working, on properties close to home. When you're dealing with development, a lot of that is being able to, to see the property, see what's around it, know what's going on in the local area, have a bead on what the cities are wanting, how the cities are feeling in terms of, whether they want new development, whether they don't want new development, what kinds of new development they want. So I think, being able to be local is very important for success in that. So, yeah.
Yeah, absolutely. I see so many investors that target many, many markets. And, my feeling is you just can't be any good at what you do if you're targeting so many different markets, and honing in on one or a few really helps lead to greater success.
Yeah, no, I totally agree. And I work with smaller teams as well. So when I'm developing or I'm, buying a property to buy and hold, we may have investors from all over the country, but the operations team, will be fairly small, small handful of people, maybe 3 or 4 or 5 people max. So we don't do properties or projects where we have, 15, 20 GPs or something. They're just kind of all over the place. We like to keep it small. We just find that works a lot better with operations. I work, only now with people that I've worked with before, so I have an idea how they work. I've seen, some partnerships that have, gone kind of sour, and the property has suffered because you got so many people with so many competing different ideas. And that's not good for, for anybody, for the partners or the investors or anyone. So, try to mitigate that risk also. by keeping the team small.
Yeah, absolutely. Let's talk about your work as a stationary engineer. What does a stationary engineer do, and how has it led you to become a better investor?
Yeah, so contrary to most people's first impression, being a stationary engineer is not designing new kinds of paper. It's actually working with building systems, and the term stationary comes from the fact that you are working in a building, so it is a stationary asset, and that's as opposed to a mobile asset like a very large ship, like a warship or a barge or something like that, which will have all of the same type of systems that a large building will have. It'll be generators, boilers, electrical systems, plumbing systems, and all of that. So a stationary engineer is maintaining all of those systems just in a stationary asset. So I worked in San Jose, California, doing that. I worked in the tallest building in San Jose, doing, basically maintaining the facility. That's a 27-story high-rise building with it's mixed use, ground floor commercial all around, subterranean parking, and then residential units above a podium. So, when I was there, I was maintaining, plumbing systems, electrical systems, cosmetic issues, pools, boilers, chillers, all that kind of stuff. And that helps me understand really, what went into building a large building, maintaining a large building, the more, kind of nuts and bolts maintenance aspect of asset management. And that just gave me a lot of experience that I've carried over into managing large properties, buying large properties. I have a better idea of what to look for, some red flags. I can pick things out a little bit easier just from having to maintain, a facility like that. And then also while I was in San Jose, I worked in, construction defect litigation at the same time, in a lawsuit against a builder, and I was doing that concurrently with being a stationary engineer. And so I just learned a lot about how builders can screw up, and, what can happen there, and how that can affect a building over the long term. And that's really helped me in my development work because, I know when I'm designing a project, I can look at things and say, I got to make sure that this is constructed right, because, if not, it's going to be a huge liability as a developer. But I can also look at things from an operations standpoint and say, like, yeah, this thing maybe looks good, or, it kind of looks cool, or, works in the drawings. But, in terms of actually maintaining this over the next, 10, 20, 30 years, like, it's just going to be a complete nightmare if it's designed in this way. So I can look at that when I'm, working with an architect and structural engineer and MEP engineer and say, like, yeah, we could stick the HVAC unit in this closet over here, but, if something ever happens, like, how are we ever going to maintain that? It's going to cost us 3 times as much to, get this thing out of the closet, to get behind it, to fix the line, and, let's design this in a way that it's more accessible, because that cuts down on our maintenance costs long term. And that's ultimately what we want, right? Is a project that we're holding for, 3 years, 5 years, 10 years, whatever it is, that's easy to maintain. So that's kind of what I learned through my career there. That's helped me in my investing and operating career.
So, as an investor who's looking to invest in a deal and maybe a ground up, what are the things that they should look for? Because they're not going to go that deep. But what are simple things that they could look out for in some ground ups?
If somebody's investing in ground up development, I'd say, make sure you're working with a team that knows what they're doing. Make sure that you understand what stage of the process the project is in and what are the risks associated with that. Whenever I'm putting a project together, I'm a developer, and, they say development's really risky. Like, I'm actually fairly risk averse as a person. Like, I don't like going into really risky deals. I like to know that, I've got a few different options that I could take. Obviously I have my preferred option, but I like to know that, like, hey, if that doesn't work out or we hit some problem, we can always pivot, build this other thing on the site. Maybe we're not going to make as much money or any money, but we can at least get out without just like losing everything, or losing investor capital or anything like that. So, understanding what the risks are, if the deal that you're looking at has been underwritten with basically only one potential option, that's all you could do. That's not a good thing. If you're relying really heavily on, the city or city council approval to be able to do anything, and a lot of your value is going to come from that, that's a big risk. Like I'm not saying don't invest in a deal like that, but make sure that, your returns or your potential returns are going to be a little bit higher. Because depending on where you're investing in the development cycle, your risk gets like less and less and less and less the further you go forward. So if you're investing in a project where they're saying, hey, we're going to buy this raw land, or we're going to annex it into a city and rezone it, and then we're going to build something, that's way riskier than if you're saying, we're going to buy this land, it's already zoned for the use that we want, and all we're going to do is design plans and then build it. That's far less risky. So, depending on your risk tolerance, you may be okay with taking on that, that zoning and entitlement risk, but, make sure you're being compensated for that. Don't do that for, 10% on your money or something. It's not worth the risk. So just understanding where the property is in its cycle, and make sure also that the property that you're building is, or, that your deal sponsor is going to build or try to entitle actually works with what's around it. Because I've seen some projects that people have put out where, the project just doesn't fit. They're saying like, hey, we're going to build this like 8-story apartment building on this lot, and you're surrounded by like single family homes that were built 60 years ago that are falling apart. And it's like, yeah, you could build this thing here. It's possible, but it doesn't fit with the neighborhood. Like, are you actually going to get renters? Are people going to want to live here? Those types of things, and look at, if the cost is feasible too, and I'll give you a good example of this. I have a project in Seguin right now that I'm developing. It's going to be a 330 unit multifamily apartment complex. And, the land that we have, we're zoned to build up to, I think, 484 units on the site, but we've only pursued plans to build 330 units. Now, we could maximize that. We could put 484 units on there, but in order to do that, it would require us to put in, subterranean parking. We'd have to build, buildings up to 4 or 5 stories, which, we'd have increased fire requirements. We'd probably have to put elevators in. And we could do that, but those buildings that we would have to design and the site work that we'd have to do just wouldn't fit with that area. Seguin's not a market like that, so we pared it back and we said, how are we going to be able to maximize value? And that's through building a smaller and cheaper product that actually fits overall with the market, as opposed to just like maximizing density at all costs. I see some people that put together projects and they kind of look at that max density and they say, oh man, we're going to buy, this, land for this much, and we're going to max out the density and put all these apartments on there, and apartments in the area rent for this much. Like, oh, we're going to make all this money. And then you kind of get further into the project and realize like, oh man, but like, yeah, apartments there rent for, whatever, $1,500 a month, but it's going to cost us, $400,000 to build each unit. And then it's not feasible. Like, yeah, if you're building in downtown Denver, downtown Austin, Los Angeles, hey, that's fine. You can maybe pay that much to build an A-class apartment. Not every market you can do that in. So, so just be careful that the project that you're getting into isn't kind of exaggerating what they'll be able to do. And they've actually done their research to make sure this product fits with the market that it's in.
Nice. And out of curiosity, how much will you be? What is the cost going to be per unit all in when you're done, roughly?
Well, for that property in Seguin, I want to say our construction cost it's like $142 a door. And then we've got land and soft costs and everything, which is maybe another $20,000. So we'll probably be all in for about $165. And then our rents, I think, are about $181 per square foot. So, the deal pencils well, but, most of that is due to, good contractor, efficient design, right price for land, the fact that we didn't engineer a building that's going to cost us, like way more money to build. So it's, those are all the things you just learn through experience and, just kind of doing it several times. I didn't know all that at first, that's why I partnered with other people on earlier deals, but, now I know that I've got the experience.
And working with a city or town that moves things along fast versus getting stuck on getting approvals, and the permitting process could add a year or many more years to your project, which costs so much more money, the holding costs and whatnot. So speed is so critical in these development projects as well.
No, that's very true. And knowing the municipality before you go in is important. You always want to make sure that you've had meetings with the cities. Like, that's a good question to ask your sponsor. Like, hey, have you talked to the city about this project already? Like, are they aware of this? And does this conform to their future use? Because every city has a future use plan 15, 20 years out. And if you don't conform to that, like, they're just going to say no. You want to make sure that you've had those discussions and they're at least open to the project. Now, that doesn't always mean the project's going to go through, and I've dealt with municipalities that were super easy, and I've dealt with municipalities that were super hard. But to your point, like, delays can be a big thing. And the other thing to remember in development is there's always going to be delays. Like, and having delays isn't always a reflection on the person. It's not always a reflection on the developer. You just need to know to plan for that. So, all of my deals, I pad the timeline like a bunch. Someone says, oh, this is going to take a month. I say, well, I'm going to plan for 2 or 3 months. Oh, this is going to take 3 months. I'm going to plan for 6 months. And you don't always know where the problems are going to come up. You just know that they are, and there are so many factors in developing a property. I mean, it could be something from, the city's requiring you to get an extra study. They found something, you have to get another study. Or it may be that there's a particular city council person that's just against the project and you got to go through a couple extra rounds. Or, you might have, an issue with, your architectural team. Like, you don't know where it's going to happen. You just know that it is. So when you're looking at a timeline, and, this for developers putting something out to your investors, and also for investors looking at developers, make sure you understand how the timeline was built. I always pad the timeline very heavily, and I put that out to investors so that they know, right? I don't go in and say like, yeah, we should get this done in 12 months. And we just added on another 12 months just in case, because my timeline is 12 months, but I also know that something's going to happen and I'm going to hit some delays. So I'm not going to tell the investor that, because I'll look bad, right? And they could lose confidence in the project, even though it's a normal part of development. And that's a hard thing to communicate to an investor, right? Of like, hey, we're going to be delayed somewhere, but I can't tell you where. But if you underwrite your deal and you have that extra time on there, it should work out. I haven't, had any projects that, just completely crash and burn because I didn't pad the timeline enough. And I'm always transparent with investors about that too. Hey, we hit a delay on here, but you know what? Like, we planned for this, right? And often what it is you overperform on some areas of your timeline and you underperform on others, right? You say, hey, we anticipated, this part of the project was going to take 2 months. We got it done in 3 weeks, On this part of the project, though, we thought that it was going to take, 2 weeks. It took us 4 weeks, right? So, we came in under over here, we're over there, but overall, we're still within our timeline as we need to be.
Yeah, I love it. That's so important. Just like running, value add multifamily, it's things will break, things don't go as well as you plan. But if you have enough buffers in a lot of different areas,
yeah, exactly.
Hopefully at the end of the day, you've under-promised and over-delivered by building all this in. So yeah, it's a great way to look at things, because there's always delays, there's always issues that pop up, and it's impossible to know exactly, like you said, where it's going to happen, but it happens. And if it doesn't happen, fantastic.
Yeah, no, and it's the same thing on multifamily and operations, right? You may say like, hey, we anticipated that our, repair costs were going to be, this much per year. And actually they were under that. But you know what? Our insurance went up, so, we underperformed here, but we overperformed here. And, as long as you can still hit your numbers overall, you should do okay.
Yep, absolutely. What's one of the hardest lessons you've had to learn in the last couple of years?
One of the hardest lessons I would have to learn is, making sure that you have good control of the assets you're participating in, or that you're putting your name behind. So at this point, I'm in charge of the projects that I'm doing, or I'm at least, a key decision maker. I did have one project that I was not a key decision maker on. And, I just kind of came in, I jumped on the GP team. I had a minimal stake, but the key decision makers, I don't think necessarily made the best decisions at the right times, and we've had troubles in the markets, right? Rising interest rates, increasing costs. It's not as easy as just buy a property and sell it 6 months later with a 2% cap rate reduction. That's not out there now. And that was a problem for me and the people that I brought into the deal. And that's not something that I would do again. I see a lot of people that, they just kind of, jump into all these deals and stick their name on anything. And that can really burn you. It can lose your investors' money. It can really hurt your reputation. If you care about those things, it keeps you up at night. I guess not everybody does. Some people don't care, but I do. And, I lose sleep over it. And, so I won't do any more projects where, I don't have a key role in saying, hey, these are the decisions that need to be made. This is what's important to keep this property going. And preserve investor capital, and, make sure that the project is operating well, and, be upfront with the investors. All of that stuff is very important. And I don't ever want to be stuck in a situation like that again.
Yeah, absolutely. I think a lot of people, particularly people that just focused on the capital raising side, got involved with syndicators that were just pumping out deal after deal after deal, and they're like, "Oh, I'm making all this money," but the reality is, at the end of the day, they're going to lose a ton of money for their investors, and they're not going to make the money that they thought they were going to make because the deal's gone south. So
right, there's a lot of that out there right now.
Yeah, absolutely. Well, Andrew, I appreciate you coming on the show and adding a ton of value on development. Please tell the listeners where they can find out more about you and your company.
Yeah, for sure. If people want to learn more about me, you can visit my website at IronGallInvestments.com. That's IRONGALL investments.com. And you can also reach out to me personally. My email is just Andrew@IronGallInvestments.com. You can find me on Facebook or LinkedIn if you want to reach out. I'm always happy to chat, share my knowledge. And, I just love real estate, love the space, love chatting with people in it. So, don't hesitate to reach out.
All right. Awesome. Thanks again. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.